Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money, and today I'm joined by Richard Staveley of Rockwood Strategic. Richard, you're a smaller companies investor in UK companies, which is a very interesting area and one where lots of investors in the UK, they like to hear about that kind of stuff. They like to hear about those stories, but it's a sector that's had its difficulties in recent years, which we'll discuss as we go through what you do. But first of all, can you tell us a bit about how Rockwood invests and what it does?
Sure. So Rockwood Strategic is an investment trust listed on the London Stock Exchange. So we've got long-term capital, and we invest in the smallest of the UK small companies. We're a value investor, so we look for businesses that we think are trading below their fair value or intrinsic value. And we invest in about 24 currently UK small companies. It's quite a concentrated fund. We're engaged in as much as we'd like to build stakes in the businesses that we invest in. And then we engage with all the stakeholders to try and catalyse change. So what we like is basically companies where they can benefit from operational, strategic or management initiatives which will kind of unlock or value or release value or get things going. And that's basically what we do. We've been doing it for a number of years now. I've been managing the fund for 5 years. We're about £100 million fund, and I think we're the best performing fund actually over the last 5 years. We're very pleased to be.
And one of the things I noticed when I was looking at the fund was that you hold sort of that 24 companies that you said, but of that 24, about 10 of them make up quite a large proportion of the fund. Why do you choose to invest like that?
I think there is an element, it's always been that, and it's fair to say I took over the fund 5 years ago and it was set up like that. And I think a lot of fund managers are actually pushed into having much more diversified portfolios, often because they're worried about volatility of performance or the underlying liquidity of their holdings. But I think what sits behind it is a bit like the great Warren Buffett, who's obviously sadly retiring, is that the concentration effect means that you really get your best bang for your buck if you concentrate your focus on your very best ideas. So we've got about 63% of the portfolios in that top 10. Our largest position's about 13% of the portfolio. But historically, when they've done really well, they've run up to 20% of the portfolio. In all those instances, companies have then been taken over, and we've made lots of money for Rockwood shareholders from them. I think one of the things that I enjoy about having a concentrated portfolio is that you have more time. So if you're running 70, 80 holdings, your time, if they all have interim results, final results, maybe a big capital markets day for the city, a third of them might do an acquisition once a year. You've got a lot of information to keep judging, in addition to trying to find new companies. But with a more concentrated portfolio, you're just trying to find your very best ideas, and you can spend more time on them, both beforehand, before buying them, but also once you've taken a stake.
And how engaged do you like to be with those companies? Are you the type of investor who likes to be speaking to them a lot, or do you like to take a step back?
Yeah, we actually are really very engaged. So if you rang up any of the CEOs, they would say we're probably one of the most engaged investors they've got.
They
in the
say,
register.
"Oh, not that bloke again. He's always on the phone to me."
I hope not. We try and get it the right level, and we try and back good management teams. We often, in the first instances, we might be involved with actually changing or evolving the management team or the board, because the majority of our shares are actually turnarounds and recovery situations, often that have had a period of underperformance and performed poorly, and the market's given up on them. Investors, don't like them. They think it's sort of game over. And when we get involved, take our stake, and then, as I said before, get engaged with maybe other shareholders as well to say, look, we need to change this guy or this evolve the board and unlock value through improvements. We have good relationships with them. It very rarely gets aggressive in that sense, and it's different definitely than how the Americans do activism, which is a lot more sort of shouty, and in the public realm. We like to do things more sort of, we like to call it sort of constructive engagement. It's kind of a nice phrase. So we sort of do it behind closed doors, work with management, and often they know that change is needed. And obviously, if we've got bad ideas about things to do, so say if it's one of our companies that's got too much leverage and they're sitting on a division which isn't really particularly going anywhere or needs to be stabilised but doesn't need to be part of the group anymore. They might know that it might be they may not have thought of selling that division in its entirety, but if it's a good idea, they typically come round to the idea, and then things can happen. So we do get stuck in much more than others, and I think that creates a role for us because a lot of investing these days has obviously gone passive, whether it be ETFs or index trackers. And I think there is a decreasing role actually for active investors like myself to just sort of sit on portfolios of stock or wide portfolios of stocks. You can kind of get that. You can actually, it's quite difficult to get it, almost impossible in small cap, but you need to prove why it's worth having us. We need to do things that the computers can't do, have a concentration that the computers can't handle, and take active risk and get involved.
And does that help make small caps less risky than they're sometimes perceived? Because I think perhaps there is a perception amongst many investors that, well, smaller companies, they're risky. At the same time as many of those investors might be happy to buy Tesla stock, which goes up and down like a yo-yo. Yeah. Does engaging with them and being active really help there?
So directly, yes. So we find that the engagement process helps de-risk the investment that we get in. However, at a general level, it is definitely the case that small companies overall are higher risk than large companies because they're typically less diversified. They've got less sources of funding. Debt bond markets might not be available to them because of their size. There's less resources in central. That said, I'm sure many of your watchers will know that you can lose a ton of money in large company shares too, whether it be BP or banks of yesteryear or whatever. So by no means is small cap just a racy field. There are a lot of companies who have good stories, narratives which excite investors, but which turn out to not be either true or accurate about the future for them. But what we find is that by focusing on value, focusing on proven business models that generate free cash flow, and then getting engaged and having a stake, and the amount of time we have for extra due diligence, we can de-risk that process quite materially. If you take our portfolio 24, for instance, like 10 of the holdings trade below the net asset value of the business. More than half the portfolio has net cash on the balance sheet. And if I take a couple of the stocks we invested in the last 2 or 3 years, just as the state of UK small cap now, one is Funding Circle, which is a business that has built a technology platform that facilitates loans to small and medium-sized British businesses. And Galliford Try, which is the construction company people might have seen their hoardings about, which builds schools and hospitals and is now helping modernise the water infrastructure for the UK. Both those shares we were able to buy at a discount to the value of the cash on the balance sheet in the bank that these businesses have. And they're both profitable businesses. So that isn't risky investing from our perspective, because you could choose to theoretically literally wind up the business and return all your money in cash, and you'd
still be up.
Yes, exactly.
Theoretically,
yeah.
So what is the thing that you look for in a business when you're investing? What's the most important thing to you?
Well, for us, our focus is this kind of recovery investing. So what we look for is the ability for a business to mean revert or go back to its average level of profitability that it's done in the past. So what we're looking for is a decent history of the company generating a certain level of profitability, typically the percentage profit margin that it makes. And then, so if we take just an example, if we take something like Trifast, a business we're invested in now, it's valued at about £90 million, has sales of over £230 million. And it's been around on the market for many years, and it distributes and manufactures fasteners, nuts and bolts, both plastic but mainly metal. And its customers sit with them for years and are into everything from autos to consumer devices to, I think they might actually be in the Tesla as well. And that business has this long history of producing over 10% margins, But under the previous management team, profits had declined and they'd got down to 3-4% profit margins. So what we would due diligence take time doing was work out has something structurally changed, which means they can't get back to 10. Have they got a history of producing 10 in different types of markets? What do the competitors achieve? Turns out they achieve 10 and better mostly. So we're looking for a business that can do. Now, what happens is when you go from 10% profit margins down to 3 or 4, the process of going from 10 down to 3 or 4, by the time you get to 3 or 4, no one thinks you're ever going to get back to 10 before, and they're sort of extrapolating it's going to remain low forever. So it's that. So when we buy the valuation based on things aren't really going to improve, and then get a team in that can just get things back to normal, that's what excites us about stocks.
The value of compounding over long periods of time. There's a lot of investments that can do well for short periods, but then they collapse or there's a big down cycle or something goes wrong with them. Whereas those investments that can continue steadily growing their profits and dividends year after year and compound that are incredibly valuable. Lots of people talk about it, but not a huge number of people actually practice it. The patience of hanging on to long-term compounding in earnings and dividends. So the value of compounding would be a big lesson.
And there's been a real thing about growth investing in recent years. I mean, smaller companies have a great opportunity for growth because their ability to grow is, they've got a lot further to grow into than a very, very large company. But they have been somewhat shunned by the market. Just because you're investing in a recovery play or a value play, presumably you're also thinking this company's got lots of room to grow.
Yes. So the ones we make the most money out of are the ones that are recovery situations that then morph into growth situations. And we do have one in particular that I'll mention in a moment in the portfolio that it's very, very exciting that does that. Typically, we will make our target returns just from the recovery. So we target at least 100% upside in every investment we make. And we have a time horizon of about 3 to 5 years for that to sort of play out. And that meets our kind of target returns. We're targeting about 15% a year over a 5-year rolling period. So it's actually called Filtronic, and Filtronic was a £25 million business that is in the radio frequency space. Had net cash, was profitable, but was just sort of having some subtle changes in its management. A new chairman came in, the CEO has subsequently changed, but a new industry was opening up for them, being the space market. And they've gone on to win huge orders from Elon Musk's SpaceX for his Starlink satellite network. And the stock, and this is whilst everyone hates UK and talking about US exceptionalism and the Magnificent Seven. Well, Filtronic's gone from 12p a share, which when we first started buying, it was actually even lower than that, but we started buying at 12p a share to about £1.15 today. So nearly 10 times your money in a difficult market. So you can get these huge returns, and that's now definitely a growth business. On your question about growth investing generally, good growth investors do generate good returns in small cap over the long term, and there's a number of those guys around. That said, in the period of zero or pretty much zero interest rates, growth stocks themselves got re-rated to, in my view, overvalued levels because of the very low interest rate. And because it was such an extended period, after a while, everyone sort of got used to it. A bit like some people are finding out now about their years of not paying much on their mortgage, and now finding the resets are quite painful. And a lot of those companies found that after interest rates kind of normalized to a more long-term level of interest rates. That's really undermined some of the valuation cases for the overvalued shares. That said, UK small companies grow definitely, as you say, faster than large companies over time, and the long-term stats are they're pretty amazing, really. So, if you take, this is all proven by the London Business School studies. If you take the bottom 10% of the UK market by size, and if you'd invested £1,000 in 1955, by the end of 2024, that would be £10 million with
Wow.
dividends reinvested. Now, the bottom 2%, which is actually where more Rockwood is focused, we do get up into the bottom 10 as well, but the bottom 2%, that £1,000 would actually be £25 million. Now, it's a very long period of time, 1955 to 2024, and these days, seemingly everyone wants to make a fast buck in a few seconds, or day trading, or however long they hold their crypto for. But there's no doubt that backing good small businesses that can grow faster over decent holding periods, you can make really decent returns. If we take where the market is now, the AIM market down 44% in the last 4 years, stark contrast to what's been happening in America. If the return profile is going to move back to that long-term average we've seen since 1955, and obviously a lot of things have happened since 1955, good and bad. But if they are to move back to the long-term average, then actually the next few years might involve a slightly better than that average, which is averaged at about 10% for the smallest ones.
And finally, just before we finish, do you think that sentiment is changing on UK small caps and on UK companies in general?
The general one's easier. The FTSE 100 to the end of March, pre-Liberation Day, massively beat the S&P 500. I mean, most people don't. I think S&P was up 7.9% to the end of March, and FTSE 100 up 12 and a bit, and that's more in currency terms. And since Liberation Day, FTSE 100 has been strong as well. So capital has definitely started to flow back tentatively into the UK after many years of going out. And I think that's probably because the valuations are very low. So it's quite crude, but these are statistics produced by the stockbrokers Pamela Lieberman. The average AIM share is on about a PE or a multiple of current year profits of about 10 times now. The American market's on about 22 times, having kind of derated from about 25 times. So when valuations are low, and let's face it, some people quietly might think that a slightly more, dare I say, boring style of government might be more interesting place to have their capital than a slightly more exciting style of leadership. There's no doubt that a proportion of people that have benefited a lot from US asset price growth in the last few years are shaving their interest, reducing, not necessarily exiting, but definitely going, what's the right level? And when you start then looking around, where might that money go? The UK looks cheap with good businesses, good legal structures. And what we really need for that to trickle down to small cap, I think now is slightly lower interest rates, which I think are probably coming. And I think we probably at this stage need a nudge from government. Now that there's, we're having this interview around about the time of the Mansion House updated announcement. We'll see exactly the details of that in the next few days. But I do hope, and there are noises in the press, that Rachel Reeves is going to look properly at ISAs. And I feel very passionately that the ISA should be invested in UK listed stocks. Now, obviously, Rockwood Strategic is a UK listed stock, but so is British American Tobacco, and so is Glencore, which are international businesses. I'm not worried about some of the arguments people say, but that's not really helping Britain. Those companies being listed here benefit huge amounts of advisory communities, and whether that be legal, accounting, and other types of advisors. And they tend to do their business here, which benefits the capital in itself. And I feel that it's a UK tax break that if it was repurposed for UK shares, we could do a lot of good quite quickly. At the end of the day, it's UK taxpayers offering the tax break, so why shouldn't the money end up with UK stocks? I was told about 6 months ago that apparently about 800,000 people a year, just slightly over, max their stock ISA, which is clearly about 16 billion quid. So that, and bearing in mind the tax break's already there, the Treasury can't complain because it's roughly the same. So I would love that repurposed to British stocks, and then I think that would trickle down and be really helpful for our smaller companies. it's critical to happen because at the moment we've got quite a lot of money available in the angel sphere and also in venture in the UK to get things going. So it's pretty. In fact, we win quite lots of sort of surveys or do very well in surveys for ability to start a business and get a business going. But what we need is to scale our best UK businesses, the ones that can really grow. And public markets is the best place to do that. You get a broader spread of investors. It provides a market that people can change their mind later if they want out or they in. So you have a proper legal and framework, and it's a proven market over time for being able to raise capital. I mean, public markets in COVID is right. No one really mentions this, I have to say. So I have to get on my hobby horse. But in COVID, there was loads of companies that needed to do rights issues, and the public market shareholders all divvied up and kept them helped. There was obviously a lot of government support in the end as well, but public markets have a role. I'd love there to be more money to help our best companies, invest more in capital, invest more in people, grow overseas as well as in the UK, and also kind of acquire other companies rather than being acquired themselves, which is clearly happening a lot in the UK. Because if domestic investors don't care about the UK stock market, two people, definitely the trade buyers and the PE guys definitely do, and they're stealing quite a lot of our really good companies because they can see that they're undervalued.
Oh, Richard, thank you very much. And Rachel Reeves, if you're watching, that's Richard's pitch for you to improve the stock market so that we can get that virtuous circle going. Thank you very much for watching. Goodbye. Join us next time.